Good morning and welcome. You are watching Buy Now, Sell Now on ET Now. I'm Nupur Talwar Suri and with me is Kavita, and together, of course, we're going to be taking you through all the questions that you have. But before we turn to our guest, here's a quick look at how the markets are performing. Well, the Nifty firmly at this point up above the 24,600 level. It's at about 24,633. But what's happening in the two packs that we are keenly watching? One, of course, is the auto pack. That's not doing too well in the red. And looking at the companies over there, Ashok Leyland, Hero MotoCorp, M&M, Bajaj Auto, all of these taken a downturn. Turning our eyes now to what's happening in the IT sector. So the IT pack also down at this point in time, but let's look at the firms which are not doing too well. We have Emphasis, TCS, Infosys all in the red, but holding forth still is Coforge. So those are the packs that are looking. We are looking at this point. The Nifty mid cap also, pretty flattish at this point in time. But we will talk more about those stocks in focus. We are now joined by Kunal Bothra and Sharmila Joshi. Good morning, both of you, and thank you for being with us.
Very good morning.
Right. So let's begin with the first query that we are getting at this point in time. It's coming in from Hector. Now, Hector wants to know about the 20 stocks of Maruti. Says that he's been holding it for about 3 months, can hold it for longer. 7 months more, that's his outlook. And what levels should he be targeting? So let's take that question first up. Let's come to you, Sharmila. So what's your sense on that one?
Honestly, I think 7 months is too short a period, because I think definitely Maruti is a stock that, if you bought it at these kind of valuations, you should be looking at, to hold it longer. Overall, I'm positive on four-wheelers as a play, because, what we've really seen from the start of this year is the fact that the GST changes have worked in favor of auto as a sector, and definitely four-wheelers. Maruti was somewhere behind as far as the EV game was concerned, but they're catching up. And, I think there's a lot to look forward to. I think, in any month, if you pull out the top 10 selling cars for the month, at least 5 or 6 of those will be Maruti models. So that kind of gives you a sense of, the position that it holds in a country where the demand for four-wheelers, passenger vehicles is only increasing. So, I don't have a short-term view on Maruti, but it's a positive view, and I would really recommend that he holds on to it for longer.
All right, and Kunal, what's your take on that one? He wants to hold it for 7 months and no longer.
I think it's a good time frame. Short-term wise also, I think if you're looking at, I think Maruti is very close towards breaking the 200 DMA resistance around the 14,500 mark. The moment I think the stock, hopefully I think scales past about those levels, which should happen in this time frame which you have expecting, I would sense that the stock should be good for a breakout towards 15,000 to even 15,500. I'll suggest a hold.
All right, so it's a hold on Maruti Suzuki, but we have a live viewer on the phone line as well. This is Mr. Dinesh Rohit. Hi, good morning, sir. How are you?
Hi, I'm good. How are you?
Doing good, thank you. You're calling from?
I'm calling from Visakhapatnam.
All right, so you can ask your question, or experts can hear you.
Yeah, so my question is regarding Vedanta Property Platforms Limited. As we all know, the demerger is upcoming. So I'm planning to invest 1 lakh in Vedanta, keeping in view the demerger of Vedanta Property Platforms. So I would like to know whether the Vedanta Property Platforms will unlock the same value as Vedanta Aluminium Debt, and what is the expected listing price of Vedanta Property Platforms?
All right. So let's take a technical as well as fundamental. I'll go to Sharmila first. Sharmila, do you like his strategy?
Well, honestly, once the main demerger happened, my attention has really been on some of the other play, Vedanta Aluminium, as he mentioned. So I'm not too clear on how this, I'm not really worked out the pricing that Vedanta as well as Vedanta Real Estate would get. What I do understand is that a lot of debt will stay with the parent company. So from that sense, I think that, even once the split happens, maybe you should choose to be with the Vedanta Real Estate bit. But, you can definitely take a technical call on this as well.
Also, Dinesh, just out of curiosity, are you open to invest this 1 lakh in any other counter? I mean, I'm sure it's an investment perspective, but any specific reason why Vedanta and this strategy, or you're open for other recommendations? Because then accordingly, we can take a take from Kunal and maybe more names from Sharmila as well. Dinesh.
Sure, I'm open for recommendations. The reason why I'm preferring Vedanta property platforms is we have already seen the demerger of 4 listed entities and
Absolutely.
the value it has unlocked to investors. So, and Vedanta having a robust, the land book. So I'm expecting a decent listing, so I would like to take your view as well on that.
Perfect, perfect. Kunal, on a specific question, I'm not sure if you have a recommendation, but otherwise 1 lakh rupees if he wants to invest where great valuations and great timings.
See, valuation is of course difficult to say, but I think in terms of timing, looks like that the defense stocks are making a comeback. You might want to look at HUL at the current levels. I would sense after this up move, the stock is very close towards a multi-month breakout. So that could be one stock which you may want to keep an eye on. Reliance, I think, is also trying to come back into its own. The stock has been underperformer for a prolonged period of time. I think at this 1300 levels for Reliance Industries, the risk reward looks to be fairly positive and attractive.
Sharmila, would you want to recommend more names since now we have more clarity because he's open for other recommendations also?
One other thing that I would like to point out is that while, yes, they have spoke of a demerger, I was just trying to look while you all were talking as to whether a timeline sort of has been discussed. Because from what I remember is that from the time they spoke of Vedanta demerger, for it to finally go through, there was a fairly long sort of waiting period. And here again, I think the swap ratio is for every 20 shares of Vedanta, you get 1 share of the real estate. And they're going to transfer their real estate property there, which makes Vedanta holding even less attractive to me, very honestly. So yes, I think I wouldn't put my 1 lakh in this to start with. I would probably look at some other names, especially if you have like a year's horizon. I think we spoke of Maruti. I think even Maruti is a good name at this point in time because auto is a sector that I do like. We are seeing some profit booking coming in. I do like the two-wheeler space also within that space. So, you could look at some other sector. I'm not too sure of what the timeline on this will be and, what the breakup is going to be.
All right. Let's now move on to a WhatsApp query that we've got. I think Anita has written to us, wants to know about Afcron's infrastructure. Holds 1,000 shares at 340 rupees, is asking for an advice. Well, the stock has been down nearly 10.5% over the past month. Let me go across to Kunal on this one. Kunal, what's your view on this?
See, the view is that the stock is still evolving in terms of the price trends. So far, it's come back towards retesting of the Feb-March lows for Afcons. So stock rallied from 280 levels to 350 and then back to that 280 levels as of now. So it looks like that maybe the stock is coming back into a bottom formation, but it's not a chart which I would encourage to average out at the current levels. I would sense that if it give it another maybe 6 months or so, there could be a possibility that if the stock holds on to the support of 280-ish, which is the previous low in the month of Feb-March, then there could be a rally back again towards 300, 340 mark. So the closer you get to your cost price, I think the better it is for you to look to exit the stock, but give it a time frame of another 6 months.
Any other place where he can put the money to recover his losses?
So the two names which I mentioned, the likes of HL as well as Reliance, they could be something which you can look at.
All right, let's move on and let's take the other WhatsApp question coming in from Mr. Venkat Rao. It's on PFC and REC. PFC bought at 480. He also says that he's a senior citizen and he says he's a long-term investor, but he can hold on this counter for almost 6 months. And he wants to know if can he exit, and there is the buy price of REC he's given. He's given it at 520. That's the REC buy price also. So Kunal, let me just come to you. He's a senior citizen. Sir, I'm sure that you're aware of your risk appetite because it's just a 6 months time frame in both of these counters. Kunal, what would you recommend?
See, I think both these stocks are a hold, but I would not suggest to expect much beyond for the next 6 months because the stock price have been falling quite consistently over the last 2 years or so. I think from 2024 highs where REC was almost at 650. That stock has been constantly falling. There was a point where I think for 5 or 6 consecutive quarters, the stock had shown negative price action. expectation is that in the next couple of quarters, the stock could be on the path of recovery. But the PSU index many a times and few of the PSU stocks have a tendency of detaching themselves in terms of the index correlation. So you might probably have a point where the Nifty can come back to a breakout, but possibility that REC can continue to show very muted returns. So you can continue to hold on, but I would not suggest to average out.
Right. A quick word in from Sharmila on that one as well.
Yes, so obviously I think what we are also looking at is a merger between the two companies. I think the record date is some April of next year. You, for every 100 shares, I think, of REC, you get 88 shares of PSC. So they're going to become one company. I think that's what you should be really looking at from a longer term perspective. Because both companies, as Kunal also pointed out, they're companies that I like, but I don't see anything happening in the immediate sort of next 6 months. Because you are going to look at these sort of merger dynamics in the interim. And what the combined entity will do is that, where financing of power projects and all that happens, you will have like a larger company, and the dynamics of that will play out in terms of a bigger balance sheet, etc. So perhaps it might be best if we can hold on to wait for the merger to take place and then take a call on the stocks, because I too don't really see the stocks going up in a hurry.
All right. So I hope, Venkata, you've got your response broadly on both shares. We slip into a very short break right now. Thank you, Sharmila, as well as Kunal, for joining us.
Welcome back, and you're watching Buy Now Sell Now. It's time to get connected with all the managements releasing their quarter numbers, and we are talking about Gawar Technology and the numbers posted where revenues are almost up 31% year on year at 482 crores. EBIT margin is 18.7, almost an upside of 10 bips that we saw. But there are other highlights also released in the with the quarter earnings. Let's decode all of that. We are joined by Mr. Shujaul Rahman, CEO Gawar Technical Fibers. Hi, good morning, and welcome to the show. So a strong set of numbers delivered by you, more than 30% revenue, EBITDA growth as well is very good. How sustainable do you believe this growth is over the next few quarters from now?
Good morning. Thanks for having us on the show. Yeah, the results have been very good. 31% top line and 20% bottom line growth is a very encouraging number. And I think, as you mentioned some time back in our last interaction with your channel, quarter 4 was looking very positive for us, but we had some last-minute issues due to Middle East crisis, and some of the material got shifted to this year. So we got a very good gain this year in quarter 1. These numbers are sustainable because the quarter 2 pipeline is also looking very encouraging. As we speak, there are still challenges, external challenges, which we are trying to overcome. One obviously is the issue of logistics, export logistics. There is shortage of container. There's also freight increase, which we are trying to work on, and also raw material is still volatile. But given all this situation, we are working around the clock to ensure that the quarter 2 results are also good. So things are positive for quarter 2 also.
Right. So synthetic cordage emerged as the biggest growth driver this quarter. Now, could you break down the contribution from domestic demand, salmon aquaculture, and the recovery in the US market? Now, which of these do you expect to remain the strongest growth engine?
For us, the biggest segment is aquaculture. We had, as I mentioned, good order book into this year, and we've been able to get these orders executed in quarter 1. And some of the material of last year also came into play this year, and we got good deltas in aquaculture. So demand for aquaculture is still solid. As I was just doing some research to find out that the demand for aquaculture globally has grown at a rate of 5% the last 10, 15 years, and it's going to increase at 7%. And 7% demand increase for fish definitely means that for a product like us, which are valued product, and we maybe go at a faster pace. So the demand outlook is very positive for salmon and overall for other aquaculture species, and also for Q2. Sports was impacted last year due to tariff issue, but we were able to retain our customers, and we have very long relationship with these customers, and now things are looking very positive. We have very strong order book. Geosynthetic, which is the infrastructure space that we operate in, has been doing very well last 3-4 years. Continue to do well. Last year, the growth has been more than 40% CAGR. So this quarter also has been good. And then what is important is the domestic business, other than geosynthetic, which is typically in the area of fisheries, trawling, and industrial segment. These businesses were not doing so well last few years, but now they are on path of great recovery. And we had a structure change, and things are looking very positive for domestic. So overall, I think all cylinders are firing at this point. That's a good thing.
Sure. Mr. Rahman, the US business has recovered after tariff-related disruptions. Now, how demand will you say that has been normalized fully, or are there any remaining trade or policy risks that investors should keep an eye on?
So demand has been good. See, USA is about 10% of our business. It's not a very big part of our business, and that got impacted last year. But this year, the demand outlook is good. Orders are coming. There's obviously, as we read in the newspaper, there is a tariff risk still looming, which we don't know and we can't control. So we have to anyway do our best and ensure our customers are happy. So the order position is very strong, and USA market is looking positive. And we'll keep executing. There is a little bit of risk people are talking about, but we can't control that.
Right. Also, Mr. Rahman, geosynthetics continue to deliver strong growth and excellent profitability. Now, what structural trends are driving this business, and how large do you see this opportunity over, say, the next 3 to 5 years?
So these are geosynthetics is use of polymer products for infrastructure. So we are in the slope protection, rockfall protection business, hazardous waste management system, and also a little bit of international business in geosynthetics. So on all the fronts, the business is looking positive. We've been able to sustain this level of growth for last 3 years, and we are positive that the next few years also we'll be able to maintain this trajectory. The expenditure by the Indian government on infrastructure space is obviously helping us. It's like a little bit of tailwind for us. So that's helping us.
All right, but despite significant cost pressures, EBITDA margins remain broadly stable year on year. What operational efficiencies or pricing strategies helped protect this profitability?
So when there was a raw material increase towards March and April, we were able to pass through because we operate with our customers in a value segment. We have value proposition-based product selling that we have been working for many years. So we were able to pass through with a lag. So that impacted our margins a little bit this quarter. Also, aquaculture business was very solid this year. Aquaculture is the highest segment for us in terms of margins. So that also impacted our margin positively. In fact, the domestic fisheries business, which is also a big business for the domestic market, is also a high margin business. And normally this quarter one is the season for fisheries business, which also impacted our margin positively.
Right now, the Middle East conflict, of course, is dragging on, and it is creating quite a bit of uncertainty. In a prolonged disruption scenario, which parts of your business do you think will be the most exposed, and what contingency plans do you have in place?
So in terms of RM availability, RM is available. As I mentioned a while back, we are able to pass through the RM increase. So the volatility in RM, we are able to pass through. So that from that angle, we are kind of covered. The external risk of container availability, logistic is a bigger risk. And in terms of capacity, we have enough capacity to produce. So that's the only thing which we are working on. We are closely working with all the shipping lines. Our team is working around the clock to ensure that we are able to execute our dispatches on time, material reaches on time. That's the only risk we are working, and we are trying to solve it. Our ports are also not the big ports because mostly aquaculture companies are based in small ports. So that also creates a problem for us. But last few quarters, we have been working to try and solve it. The freight rates are now highest post the COVID. In many cases, increase of 2% to 200% or so. So that also has been discussed with customers to try and solve it. So that's one challenge we look at. RM volatility is also a challenge, but that I think we can manage.
Innovation and new product development, that remains the central part of your strategy now. Could you share which new products or technologies you are most excited about and how they could contribute to future growth from here on?
So our technology innovation is in various spaces. We are working very strongly towards new products which are in the pipeline for aquaculture. There are certain products which are also in pipeline for our segments in value-added rope segment, which is a segment which we are trying to expand. And in geosynthetic also, there are certain products which are being trialed with certain government bodies at this stage and which are showing very good signs. So these are something which is on the anvil and we are working on. And very soon, I think we'll be able to showcase the results of these innovations.
Right, Mr. Rahman, appreciate your speaking to us on ET Now. Thank you very much for joining in.
Thank you so much. Thank you.
All right, with that, it's time for a very short break on Buy Now, Sell Now. Kavita and I will be here, so do remain. Welcome back. You are watching Buy Now, Sell Now, and it is the earnings quarter, so we will be moving on to look at earnings. Let's begin with Bikaji International. Now, they've come in with a good, decent set of numbers, revenue, PAT, EBITDA, and EBITDA margin all in line at this point. And joining us on the show is Manoj Verma. He's the CEO of Bikaji Foods, and Rishabh Jain, the CFO of the firm. Good morning, both of you. Thank you very much for joining us on ET Now.
Thank you. Good morning.
Right, so Mr. Verma, if I could start with you first. Now, despite the healthy volume growth, gross margins remained under pressure. How do you expect the raw material basket really to evolve as we go further in FY27?
So if we look at gross margin, there's improvement. It's an upward movement in the gross margin. It's about the EBITDA, which slipped a little bit. And that's on account of the planned marketing investment, what we did in Q1, so as to reap the base benefits in the quarter.
All right. Rishabh, if I could just come to you because, the pricing action, we sense that that's already been undertaken so far. How much more in the offing and any impact on the margins because of this now?
So we are taking 2 price rise in last 4 months. And I think that will be managed the overall portfolio, overall gross margin then. So we will look at because we enter Diwali season, we look at next 3-4 months how this price go. And there will be some pressure. There will be pressure of 50 to 100 basis points, but we'll manage on gross margin efficiency front.
Okay, Mr. Verma, of course, Diwali season is going to be something that you will be looking forward to. But the mix continues to shift towards focus markets and Western snacks. So how should we think about the long-term margin profile of these businesses relative to your traditional ethnic snacks portfolio?
So our gross margin in Western snacks versus ethnic is not so much different. It's largely same. So we'll manage same gross margin. That's what. And improvement will be done at both ends, in ethnic snacks as well as traditional snacks. As we are entering Diwali season, we are looking good Diwali season. We are seeing some good demand from all modern trades and everywhere. So in sweets also, our gross margin is reasonably good. So we'll looking into expansion in gross margin compared to this quarter.
All right, Mr. Verma, what strategic benefits do you expect from the Nepal JV, and when do you anticipate it becoming operational and earnings accretive?
So I think it will take almost about a year to start to get commission. The simple benefit what we'll get is in terms of the import duty there in Nepal is extremely high, which takes away the competitive strength of ours there. So once we produce there, we will be able to compete with the ones who are producing there, the Indian brands and also the local brands there. So I think that's what will unleash our growth opportunity in this market.
Right, Mr. Verma, this one's for you as well. Now, distribution expansion has remained strong. Going forward, will growth be driven more by deeper penetration into the existing markets, or do you think expansion into newer geographies is something that you're looking at?
So it's a mix of both. So in the markets where we already have reasonably good reach, that's where the growth driver would be throughput per store, the category expansion, the deeper penetration there in itself within the store. Whereas in the focus markets or the other markets where our reach in itself is not up to the mark, there the larger driver would be the new store growth. So it is therefore the mix of both these stuff.
Right. Rishabh, now as the biggest trigger now will be the festive season, just wanted to understand a demand trend. If we have to understand the urban as well as the rural markets so far, how confident are you on a double-digit revenue growth just basis on this festive season?
So we are looking at good festive season as of now. So June and July has been very good for us as we're entering Rakhi this month and Diwali. So we're looking at good 15 to 17% growth. That's what figures comes our sales team and all team is wanted to.
All right. Rishabh, a quick word also on the PLI front and how can you aid business for the rest of FY27?
So overall, from PLI front, government has been very supportive on this, and we got PLI last year, and this year will be the last year where we get PLI. So this year we'll get complete PLI, and we got close to 261 crore rupees of fund in overall 260 subsidy from government, and that's how. And from demand front, so we see good demand overall. Overall for the year, we are targeting close to 15% plus growth in this year.
Mr. Verma, exports have underperformed despite investments in overseas expansion. What strategy is at play to improve the competitiveness and scalability of the international business?
So I think it's not about the competitive pressure. It was the few external pressures such as some uncertainty in US markets with the tax structure changing and all that stuff. That's one. Second, with the Gulf War, crude prices went up the roof. So the freight charges have almost gone 2 to 3 times. I mean, those were the factors wherein there was a little bit a negative sentiments and people were differing in this stuff. But otherwise, in terms of demand, product, and all that stuff, rest all falls in place. It's matter of time, should get resolved, and we'll be back on track for what we have said.
Right, Mr. Verma, anything that you have in terms of store additions, really, are you looking to expand further in terms of opening those?
So is that the general trade you're talking of? Or are you talking of the retail stuff? Stores?
The retail.
Hello?
I'm talking about the retail.
Yeah. So retail stores, if we talk about our FMCG business, we would be adding 50,000 stores by till the end of this financial year. 17,000 have already got added, and the rest will happen. So we'll cross 400,000 direct reach in our FMCG business. In our the QSR format, we would add about 10 stores by end of the year more.
Mr. Verma, if we could just understand the revenue contributions from QSR and others, same-store sales growth, how are you looking at expanding now in the next, in the coming quarters, and also in terms of product innovation and maybe offering more, since you mentioned that there's festive season on the anvil and that's a bigger time for you also. Anything planned?
So from QSR front, retail front, it's contributing close to 4.5% to overall business. Like THF, where we invested, so they will do close to 160, 170 crore top line this year, and from our business close to 40 crore rupees. So that's what overall 4 to 5% overall mix of retail to us. And from new product NPD, that's a regular progression for us as a business, and we target at least 1.5 to 2% of top line addition by NPD every year.
Rishabh, if I can take one more question, how is the shift towards optimizing supply chains via the UAE subsidiary significantly? Is it reducing your logistics cost, improving margins for exports to GCC countries?
So it's too early. Largely the plan is to, as UAE is a very big market for us, and we are targeting that to target UAE. Manufacturing will be easily solvable, and we can target big market there in UAE. That's a target.
All right, now we have, of course, talked about the pricing action, but anything that you are looking at in the near future, Mr. Verma?
So not for now, as Rishabh just spoke, that we have taken a couple of price increase, which would suffice meeting or bridging the inflation, what we have witnessed. And also the Diwali season is round the corner now. There are, already we have booked orders and all that advanced booking. So that would jeopardize our business and commitments what we have made. So at least till Diwali we will not do, and we have already built in that the increase what we have taken.
Mr. Verma, we have already spoken about the Nepal JV, but I still wanted to understand, if you could elaborate on the geopolitical risk associated with establishing manufacturing operations in Nepal, and also how does all of this, the partnership with CG Savory Corp mitigate these risks also? If you could just elaborate on this.
So, see, it's not that only for, let me pick the geopolitical stuff. So it's not just Bikaji which is venturing into this. There are many other companies which already do this stuff. So it's a stable business for that reason. In terms of our JV with CG Foods, so there is the all legal, all statutory compliance. The agreements are well, drafted, well noted, so as to avoid any ambiguity going forward. So that's what it is. In terms of our business, as we liberate ourselves in terms of increasing our distribution reach within the market and using CG's distribution network. So we feel that it should be a win-win both for the CG and Bikaji as a company.
All right. With that, thank you so much, Mr. Verma, Mr. Jain, for being with us and answering all the questions. Thank you.
Thank you.
Thank you.
All right, time for a short break, but post that we'll be focusing on more quarter numbers and more management commentaries coming up. Stay tuned. Welcome back. You're watching Buy Now, Sell Now. This is the last leg of the show where we'll be focusing on a lot of stock-specific news and also management commentaries. And the management in focus is now of Morphin Labs. A very strong set of numbers, highest ever quarterly revenue reported. Profit has surged nearly 5x year on year. And to talk more on this, we are joined by Mr. Sushil Suri, CMD, Morphin Lab. Hi, good morning and welcome to the show. Congratulations on delivering a very strong quarter, sir. But could you walk us through the key drivers behind this performance and which of these do you believe are structural versus one-time numbers? And additionally, is this growth sustainable over the next few quarters?
Yes, thank you. I would say, Nupur and Kavita, that this quarter is very important in two aspects primarily. One, of course, there's a much better operating leverage. So the performance is improved. When I say operating leverage, so it's more permanent. So second, of course, is that the existing business, the API business, which was under pressure for last few quarters, this has come up very well. And the structural development is that, yes, the CDMO business, which was I would say icing on the cake, that has started. And now as we see that we were expecting the shipments to start in Q2, but the team has done an excellent work. And of course, all the approval from customers have come in time. So we have been able to do the shipment in the Q1 itself. So that's a structural change. If we talk of high level numbers, so the revenue has grown 34%, almost 575 crores. But the throughput is much better. So EBITDA, it has increased 207%. So 34% increase in revenue and more than 200% increase in EBITDA. That itself speaks that the operating margins are much better, efficiency is much better, expenses are covered much better. And the API business has grown 31%. So that also is a big achievement because last year, same quarter, API business under a lot of pressure. And you would appreciate that this is despite the global disturbance. There are price challenges, there are shipment challenges, there have been cargo disturbances, and all these things taken together. So we have grown 26%. The profitability is much better, and we are prioritizing which customers to feed, which customers not to feed. And the important development is that against the 823 crore EBITDA CDMO order, we have been able to supply at least a part shipment to begin with. So this itself validates that the team is capable, systems are adequate, regulatory approvals are in place. So it is no more a one-time paper order. So now we have gone into the shipment part. Coming specifically to your question, is it a one-time thing? I would say since at least 4 or 5 quarters, we have there to complete this order. And typically in this type of business, so most of the time the shipments and order quantities are regular, but of course it's all subject to regulatory approval, subject to our commitments. But we see this business to be on a continuum.
Right, Mr. Suri, now let's touch back upon the CDMO opportunity. Now, how diversified is the current CDMO opportunity pipeline across customers and therapeutic segments? And how do you really plan to reduce dependence on any single client?
I think that's a very important question at this junction. And to be upfront, this single order of 825 crore, of course, shows a dependence on on single customers. It is as big as our complete API business in last 40 years. But obviously, the management is working to broad base the customer portfolio and customer pipeline, and otherwise also on the therapeutic class also. This particular product is more on the chronicle side, so that's where the quantities are large and we see regular quantities coming up. But as we go forward, we are working to expand the product base and we are working to expand the customer base also. So typically in these kind of things, it take 2 to 3 years to develop a customer. So this is a long-term process, but customer concentration would always be, I would say, high in these cases. And unlike our API business, where we are doing transactional business, 1,200 customers, no single customer is more than, say, 20, 30 crores. So here, if we get large customers, even if we get 2, 3 customers, so we are comfortable there. But we are working on it, and it is certainly a risk profile as on today. But going forward, we will be working on it.
Mr. Suri, has the successful commercial execution of your first CDMO project improved customer interest or accelerated discussions with the new global clients?
I would say I can't give you too much information on this platform, but you would appreciate that why we were in, I would say, mad hurry despite the global disturbance to supply this order. Because of these all disturbances, only we got into the game. So we had to prove our credibility. And of course, we had a credibility on regulatory aspect. We had a credibility on chemistry. But obviously, to supply such a large order, we got order in the end of February, rather almost 26th February was our press release. From 28th onward, this West Asia war had started. So all during this war position, we have been able to supply. So obviously, there is a customer credential. And we have been dealing with the multinationals and global customers over 90 countries. So we had this credibility in place, but supplying large quantities in a single order was a big challenge because it needs a lot of alignment of machinery, working capital, regulatory thing. So we have been able to, as a prove, and the team has done a wonderful job.
Right, Mr. Suri, so you've been able to manage the risks in that case. But as CDMO scales up, how do you expect the revenue mix between APIs and CDMO to evolve over, say, the medium term?
As we see in the coming 2 to 3 years, CDMO revenue would be more than 50%. And we are seeing it, I would say, by end of this Q4 only, Q3, Q4 only, we will be able to see it. But going forward, we are seeing that API has its own journey. But in API, we are trying to optimize on the profitability part. On CDMO, we are trying to optimize more on the expand customer base, expanding the capacities. So we are expecting that in the medium term, it will become 60%. By Q4, it will be more than 50%. And going forward, maybe if we say project another 1 year, so it can go even up to 75%.
EBITDA margin has crossed 15% this quarter. Which factors are structural versus one-time? And what is the sustainable margin trajectory as CDMO contribution increases?
Here I would say that, like I said earlier, one, of course, is the operating leverage, which is sheer number increase and the volume increase and the better capacity utilization because expenses are almost stable. So I would say expense increase is, for example, revenue increase is 33%, EBITDA increase is 211%, 210%. That itself speaks that at the same revenue, at the same expense, we are doing better job. So second thing which is sustainable is the better product margin, better this product mix in case of API. In the earlier time in API, we had many customers and many market which were very low yielding, I would say, because of the price factors globally and price factor within India also. Now we are trying to optimize the customer basket. We are trying to prioritize our capacities, which customers to offer, which customers not to offer. So that is giving us. And structural change, like we talked, this EBITDA margins in the CDMO business is particularly higher. So the blended EBITDA would always be in the same range. And we expect rather margin profile to improve as we go forward. So, but direction is right. I cannot give you any specific numbers, but we are in the right path. From a historical level, we are much better off.
Now, API profitability has improved due to better product and customer mix. Now, how much additional scope remains for margin expansion through further portfolio optimization and customer mix improvements?
Within API, I would say we are almost on the right corner, but it doesn't mean that there is no improvement possible. But in API, the margins will improve with the new molecules and, of course, with better profitability mix. But major margin improvement will come now from the portfolio mix between API and CDMO. The more CDMO journey comes in, so the more margins will improve. And we are expecting the blended margins profile to be much better.
Many Indian pharma companies are expanding their CDMO capabilities. Now, what differentiates Morphin's offering, and where do you believe you have a sustainable competitive advantage?
That way, I would be very upfront that Morphin had 40 years of regulatory approvals and regulatory, I would say, credibility in our hand, and we have the manufacturing skill in our hand. How we differentiate, one is very clearly on the regulatory front. For example, our facilities have been inspected and approved by US FDA since last 20 years. And in last 4 consecutive approved inspections, we had nil 483. The FDA has not pointed out any material observation. So that's one milestone. Customers love consistency, and they love quality and adherence. Second point is on the regulatory approvals other than the US FDA. So we have filed DMFs and CEPs all over the world, and in last 25 years, we have a track record of nil import warning, no import alert, no red flag, no callback. So we have a great credibility on this quality aspect. Second thing which is there is the ready-made capacity. Most of the CDMO players, so they are work on the research side. So they do not have large ready capacity available. So Morphin has a ready capacity available. Rather, we have realigned our existing portfolio to accommodate the CDMO. Of course, the new capacities are coming up. So this is another advantage. And most important advantage is delivery. So within 3 months, we have been able to deliver the first shipment. So that itself, I would say from a company point of view also, it's an achievement. And you are seeing the numbers, you are seeing the needle move, that within 1 quarter, we have been able to move the needle.
Mr. Suri, now the last question before we let you go. As you transition from a commodity API player to an innovation-led manufacturing platform, what really are the key milestones or performance indicators, so to say, that investors should be tracking over the next 3 to 5 years?
I would say the first, of course, is clearly the capacity upgrading, because we are now realigning the existing capacity. So capacity, I would say augmentation is the first thing. Second is building a new portfolio on the CDMO orders, whether in terms of products or customers. And third important is that within CDMO also, presently we are doing small molecules. So from small molecules, we have to graduate to more innovation-led products. So we have already set up a pilot plant for the hypos, which is the high potency APIs. So that will be more of a, I would say, addition to APIs, but we expect some growth on both sides. On the CDMO side, of course, the near-term milestones would be more of customer augmentation, but long-term milestone would be that we enter into the customer requirement, which is more on the roadmap, and that is on the peptides and oligonucleotides. So we have to realign our portfolio mix according to the customer mix. In API, we had a product list and we used to go, I would say, shop to shop, customer to customer, that, okay, this is my list, will you buy? And at what price? Now we need to see and realign our things according to the customer profile. If the market is going towards peptides or nucleotides, we have to realign our capacities and our capabilities according to that.
All right. Absolutely. All right, Mr. Sushil Suri, the CMD of Morphin, thank you very much for joining us on Buy Now, Sell Now.
Thank you.
Well, I'm afraid we're running completely out of time on Buy Now, Sell Now. You're watching ET Now, and do stay with us.